Welcome to The Explainer. Today, we're putting on our sell-side analyst hats to initiate coverage on Flagstar Bank, ticker symbol FLG. We're going to dive deep and conduct a really rigorous, fundamentals-based valuation using both absolute and relative models to figure out what this bank is actually intrinsically worth. Whether you follow the banking sector closely or you just want to level up your fundamental analysis skills, we're going to separate the current market hype from the cold, hard financial reality.
Okay, let's jump right in. We're going to follow a 6-step diagnostic framework today, starting with the market perspective, moving into fundamentals and profitability, cash flow and debt, the shrinking dividend, relative valuation multiples, and wrapping up with our final valuation verdict.
Section 1. The market perspective. Let's start by looking at current market sentiment and seeing exactly how this stock has been trading lately. At our last check, Flagstar Bank closed at exactly $14.38. Now keep in mind, that price on its own is just the market's current consensus. It doesn't actually tell us if the asset is cheap or expensive, it's just our baseline. It's what we have to test against to see if the underlying fundamentals actually justify the price tag.
And on the surface, things look pretty rosy, right? The stock has some really solid momentum. Over the past week, it's up over 4%, the 30-day return is nearing 6%, and year-to-date, it's sitting on a very respectable 14.31% gain. But, as analysts, we can't just blindly trust a stock chart. Short-term momentum can totally detach from the actual financial reality, so our job is to dig under the surface and look at the actual cash being generated.
Which brings us to Section 2, Fundamentals and Profitability. Let's pop the hood and see if this engine is actually producing any profit.
Well, the numbers here are pretty brutal. Over the trailing 12 months, Flagstar reported a net income deficit of $89 million. Their net profit margin is sitting at a very distressed negative 8.34%. But here is the real kicker for me. Return on equity is negative 1.10. If we view this through a residual income model framework, a negative ROE means they are literally destroying book value for their shareholders. It completely contradicts that nice upward trending stock chart we just looked at.
And because earnings are plunging so far into the red, our traditional valuation metrics start to break down. Take the PE ratio, for example. It's sitting at a massive negative 65.36. As analysts, this is a glaring red flag that relative valuation has its limits. You simply can't put a traditional multiple on a company that isn't making any money. So this basically forces us to scrap standard earnings multiples and rely more heavily on absolute cash flow models to find a real floor for this stock. All right, Section 3, Cash Flow and Debt. Time to check the balance sheet and see exactly how much risk is baked into this company. Just look at this dramatic shift. We're seeing a massive 265% spike in the company's current debt-to-equity ratio. Historically, their trailing 12-month average was a very manageable 0.38. Now, it has rocketed up to 1.38. This kind of aggressive leverage fundamentally warps the company's weighted average cost of capital, or WACC. It makes our valuation models way more volatile and seriously dials up the overall liquidity risk for the whole enterprise.
And compounding that mountain of debt is a trailing unlevered free cash flow deficit of negative $248 million. Remember, unlevered free cash flow is the actual cash available to all investors after paying for capital expenditures. A $248 million deficit completely explains that aggressive debt spike we just talked about. They are basically forced to go out and borrow new money just to keep the lights on and cover this operational cash burn.
Let's move to Section 4, the shrinking dividend. Let's see if any capital is somehow making its way back to the shareholders.
Unfortunately, the payout is basically evaporating. Normally, we love to use a dividend discount model to value mature banks based on their expected payouts. But that model entirely falls apart here. The 3-year compound annual growth rate for their dividend has nosedived by nearly 75%. Because the dividend is collapsing so rapidly, there is just no sustainable long-term rate we can plug into a multi-stage model. So investors are left fighting over crumbs. You're looking at a microscopic 0.28% yield, 0 consecutive yearly increases, and a payout ratio maxed out at exactly 100%. Think about the mechanics of that for a second. With the negative free cash flow we verified earlier, a 100% payout ratio strongly implies that they are using that newly issued debt just to fund the dividend. Structurally, that is a wildly unsustainable way to return capital.
Okay, Section 5, Relative Valuation Multiples. Let's see how the broader market is pricing the stock relative to its sales and its book value.
At first glance, the metrics might actually trick you.
A price-to-book ratio of 0.74 looks like it's trading at a nice discount to its net asset value, and a price-to-sales of 1.30 might seem pretty reasonable historically. But we have to be careful here. Book value is absolutely not a safe safety net when the underlying assets are actively generating negative returns and the balance sheet is drowning in new debt. Because once you factor in that massive debt load, the true cost of the company really reveals itself. The enterprise value to sales ratio takes the entire capital structure into account, both equity and debt. Since their debt has skyrocketed, this EV to sales multiple has surged 98% above its historical average, hitting 3.73. So while the equity might look like a bargain on paper, the actual enterprise is priced at a massive premium to its historical norms. Which brings us to Section 6, the final valuation verdict. After running all the fundamental data, stripping away the hype, and accounting for that massive debt, what is Flagstar Bank intrinsically worth? To cut through all the market noise, we're relying heavily on our discounted cash flow, or DCF model. The way this works is we take those unlevered free cash flows, project them out over a forecast period, apply a terminal growth rate, and discount it all back to today's value using a risk-adjusted rate. It's a pure, absolute valuation method. It gives us a fair price based solely on the company's actual ability to generate hard cash, completely ignoring whatever the stock market is doing today. And here is the brutal reality of our financial autopsy. While the market is happily trading this stock at $14.38, our DCF model pegs the true intrinsic fair value at just $9.47. That is a massive disconnect between market sentiment and fundamental cash generation. The raw data simply does not back up the premium. That leaves us with a deeply negative margin of safety, negative 51.79% to be exact. From a fundamental perspective, this looks like a heavily overvalued asset trading purely on momentum. So you really have to ask yourself, is the market pricing in some kind of miraculous turnaround, or are they just completely ignoring the reality of the balance sheet? Are you willing to pay a premium today for a business that burns cash, or will you wait for the intrinsic value to catch up to the ticker price? Keep your eyes on the data, and I'll catch you next time on The Explainer.